Have you ever stopped to think about the money in your pocket? Or more likely, the money you access through your phone or a plastic card? It feels constant. It feels solid and dependable. But the truth is, money is never static. It is always changing, evolving with us. From shells, salt, gold coins, paper bills. Today, we are standing on the brink of another monumental shift, a transformation so profound that, by the year 2050, the very concept of money and finance will be almost unrecognizable. This isn't science fiction. This is the reality being built right now, one line of code at a time. This change is not just about convenience. It is not simply about tapping your phone instead of counting out cash. This is a fundamental rewiring of the global financial system. How we earn, how we spend, how we save, how we build wealth. It will redefine who has access to financial services and who gets left behind. The systems that have governed our economies for centuries are being challenged, and in some cases completely dismantled. The revolution is quiet, happening in data centers and on blockchains. But its impact will be felt by every single one of us, in every corner of the globe. Imagine a world where your bank is not a building, but an algorithm. A world where your financial advisor is an artificial intelligence that knows your spending habits better than you do. A world where you can send money across continents in seconds for fractions of a penny without a bank acting as a middleman. These scenarios are not distant dreams. They are the tangible outcomes of technologies that are rapidly maturing and converging. The question is no longer if our financial world will change, but how it will change, and what that future will look like for all of us. In this documentary, we will explore this fast-approaching future. We will journey from the present day into the year 2050, examining the forces that are reshaping our relationship with money. Inclusive, efficient, accessible. But we will also confront the significant risks, erosion of privacy, and new forms of systemic financial collapse. The future of your money is being decided now, and understanding the forces at play is the first step toward navigating the incredible changes that lie ahead. Welcome to the future of finance. So, why is this transformation happening now? For centuries, finance has been an industry built on trust, legacy, and massive physical infrastructure. Change has been slow, incremental, but now we have reached a unique moment, a technological tipping point. It's not a single invention, but a convergence of several key technologies. Each of these technologies is a catalyst on its own, but together they are creating a perfect storm that is forcing the world of finance to reinvent itself. And this change is happening exponentially. We are at the steep part of the curve. The first driver is the ubiquity of the internet and the rise of mobile computing. Billions of people are now connected, carrying powerful computers in their pockets. This has created a global, digital native population that expects services that are instant, seamless, and available 24/7. The old world of 9-to-5 branches and paper-based processes simply cannot meet this new demand. This constant connectivity lays the rails for a new kind of finance, a system that moves at the speed of information. The next driver is the explosion in data and the development of artificial intelligence to make sense of it. Every transaction, every click, every market movement creates a tsunami of data. And we now have the computational power and the algorithms to make sense of it all. AI goes beyond simple automation to perform complex tasks like assessing credit risk and managing investment portfolios. This data-driven intelligence is the engine that promises unprecedented efficiency and personalization, but it also raises profound questions about bias, control, and oversight. And finally, there's blockchain and distributed ledger technology, a new paradigm for trust and ownership. It allows for secure, transparent, and immutable records without the need for a central authority. While it's best known for powering cryptocurrencies like Bitcoin, its potential is much broader. It opens the door to a world of decentralized finance, where individuals can truly control their own assets. Connectivity, intelligence, decentralization, closing. Together, these are the forces drawing the map for a new financial era. To understand the journey to 2050, we need a map. This complex transformation can be broken down into 6 key interconnected trends: digital currency, cashless society, AI, DeFi, global banking, and the evolution of investing platforms. These are not separate phenomena. They feed into and accelerate one another. Collectively, they chart the course for the future of money. By examining each one, we can begin to build a clear picture of the opportunities and challenges that lie ahead. First, we will explore the rise of digital currencies and the move toward cashless societies. This includes government-backed central bank digital currencies, or CBDCs, being developed by nations like China, to the volatile world of cryptocurrencies. We'll look at how physical cash is disappearing in countries like Sweden, and what that means for financial privacy and inclusion. Next, we will dive into the world of AI-driven finance. Artificial intelligence is already making loan decisions, detecting fraud, and executing trades faster than any human ever could. Then, we will unpack decentralized finance, DeFi, a parallel financial system being built on blockchain that aims to eliminate traditional intermediaries like banks and brokers. Finally, we will look at the macro impact on global banking systems and the evolution of investing platforms. And how will an average person build wealth when new platforms allow fractional ownership of everything from stocks to real estate to fine art? Table of Contents. Part 2, Act 1. Digital Money and Cashless Societies. Section 1. Defining the New Money, from Crypto to CBDCs. Section 2. The Global Race for a Digital Currency. Section 3. The Disappearance of Cash, a look at Sweden. Section 4. The Promise of Efficiency and Inclusion. Section 5. The Dark Side of Digital, Privacy and Control. Section 6. When the System Fails, Cyber Threats and Digital Divides. Section 7. Case Studies in Contrast, China, El Salvador, and the Future. The first step in our journey is to understand the new forms of money that are emerging. The term digital money can be confusing, as most of our money is already digital, existing as numbers in a bank's ledger. However, the new wave of digital currencies is fundamentally different. We can broadly categorize them into 3 main types: cryptocurrencies, stablecoins, and CBDCs, each with its own unique characteristics and implications. Understanding these distinctions is crucial because they represent very different visions for our financial future. One vision promotes decentralization and anonymity, while another reinforces the power of central authorities. The battle between these ideas will define the next decade of finance. First, we have cryptocurrencies, the most well-known and controversial category. Born from the 2008 financial crisis, cryptocurrencies like Bitcoin are built on blockchain technology. They are decentralized, meaning no single entity like a bank or government controls them. Transactions are recorded on a public ledger, secured by a global network of computers. Their appeal lies in their promise of censorship resistance and the ability to transact without a traditional middleman. Next are stablecoins, which attempt to bridge the gap between volatile cryptocurrencies and traditional finance. A stablecoin is a type of cryptocurrency that is pegged to a stable asset, most commonly a major fiat currency like the US dollar. For every one stablecoin issued, there is, in theory, $1 held in reserve. This design aims to provide the technological benefits of a cryptocurrency: fast, low-cost global transfers, without the wild price swings that make currencies like Bitcoin impractical for everyday payments. Finally, we have central bank digital currencies, or CBDCs. This is the official response from governments and central banks to the rise of private digital money. A CBDC is a digital version of a country's fiat currency. So, a digital dollar would be the direct liability of the Federal Reserve, just like a physical dollar bill is today. Unlike cryptocurrencies, CBDCs are centralized and controlled by the state. Over 90% of the world's central banks are now researching or developing CBDCs, signaling a powerful move toward a state-sanctioned digital money future. Section 2. The global race for a digital currency. The development of digital currencies isn't just a technological experiment. It has become a high-stakes geopolitical race. Nations around the world are rushing to understand, regulate, and issue their own forms of digital money. The outcome could reshape global economic power, challenging the dominance of currencies like the US dollar. China is at the forefront with its digital yuan, or ECNY. This is not theoretical, it is a reality. The ECNY has been trialed in numerous cities with millions of citizens, used for public transport and used for online shopping. China's goals: gain more control over its domestic economy, challenge private payment platforms, Alipay, WeChat Pay, and internationalize the yuan. By creating a fast, cheap, programmable currency, China hopes to push its use in international trade, potentially bypassing US dollar systems like SWIFT. In response, Western nations are accelerating their own CBDC research, including the European Union and the United States. The ECB is developing a digital euro, aiming to preserve privacy while ensuring financial stability. The US has been more cautious. The Federal Reserve is weighing potential benefits against risks to its banking system and global currency dominance. Smaller nations are experimenting too. Some developing countries view CBDCs as a way to boost financial inclusion, providing basic banking services to citizens who lack access to traditional banks. For example, the Bahamas launched the Sand Dollar, one of the world's first live CBDCs, to better serve its remote island communities. This patchwork shows there is no one-size-fits-all approach. Each country tailors its strategy to its unique economic and social circumstances, creating a fascinating and unpredictable global landscape. Section 3. The Disappearance of Cash. A look at Sweden. While central banks race to create new digital money, an equally powerful trend is unfolding: the rapid decline of physical cash. In many parts of the world, the use of coins and banknotes is plummeting. The country that provides the clearest glimpse into this cashless future is Sweden. Once the first European country to issue banknotes in 1661, Sweden is now on track to become the world's first truly cashless society. In Sweden, cash is no longer king. According to the Riksbank, less than 10% of Swedes used cash for a recent purchase. That share has halved in just a decade. Many shops, cafes, and even banks no longer accept cash. They display prominent Vitar AJ Kontanter signs. Payments are overwhelmingly made via cards, or, more commonly, through a mobile app called Swish. Swish was created by a consortium of major Swedish banks. It allows instant peer-to-peer payments and instant retail payments. It's deeply integrated into daily life for millions. The drivers are a combination of technology and culture. Sweden has near-universal internet and smartphone penetration. There is also a high level of social trust in institutions, including banks and the government. The perceived benefits are clear. Digital payments are efficient, they reduce the risks and costs of handling cash, and they create a digital trail that can be used to combat tax evasion and money laundering. But Sweden's cashless shift has also exposed serious challenges. The Riksbank itself has raised concerns about the speed of cash's disappearance. There is a risk of excluding vulnerable groups: the elderly, recent immigrants, and people with disabilities who may rely on cash. There are also concerns about what happens if the digital systems fail due to a technical glitch, a power outage, or a cyber attack. Without a physical cash backup, society could grind to a halt. This has led the Riksbank to promote its own CBDC, the e-krona, to ensure the state maintains a role in the payment system. Section 4. The promise of efficiency and inclusion. The push toward digital currencies and cashless societies is largely fueled by a compelling set of promises. Proponents argue that these new forms of money can unlock unprecedented levels of economic efficiency and expand financial access to billions of people who are currently excluded from the system. Digital money, in its various forms, offers a path to a system that is faster, cheaper, and more accessible for everyone, from multinational corporations to individuals in remote villages. One of the most significant benefits is the potential for dramatic cost reductions. Consider international remittances. Sending money across borders today can be incredibly expensive, with fees often exceeding 6% of the transaction amount, according to the World Bank. These fees disproportionately affect migrant workers sending money home to their families. Digital currencies, whether they are stablecoins or CBDCs, could allow for near-instant cross-border transfers at a fraction of the cost by eliminating many of the correspondent banks that act as intermediaries. This could put billions of dollars back into the pockets of some of the world's most vulnerable people, representing a huge boost for developing economies. Beyond cost, there is the promise of greater financial inclusion. The World Bank estimates that 1.4 billion adults globally are unbanked, meaning they do not have an account at a financial institution. Digital currencies, particularly those accessible via a simple mobile phone, could change that. A CBDC could allow a government to provide every citizen with a basic digital wallet, accessible without needing a traditional bank account. This would be a gateway to essential financial services, enabling people to save securely, receive payments, and build a financial history for the first time. Furthermore, digital money can be programmable. For example, a government could distribute stimulus payments or social benefits via a CBDC, ensuring the funds arrive instantly and are used for their intended purpose. A company could automate complex supply chain payments, with funds being released automatically as goods move from one stage to the next. This programmability can reduce fraud, streamline administrative processes, and create new, innovative financial products and services that are simply not possible with the analog money and systems we use today. While the promise of efficiency is alluring, the transition to a fully digital monetary system carries a dark side that cannot be ignored. The most profound risk revolves around the erosion of privacy and the potential for unprecedented levels of surveillance and control. Physical cash offers a unique property. It is anonymous. When you buy a coffee with a $5 bill, the transaction is between you and the merchant. No one else needs to know. A cashless society, especially one built on a centralized digital currency, could eliminate that privacy entirely. In a world where every transaction is digital, a complete and permanent record of our financial lives is created. With a CBDC, that record would be accessible to the central bank and, by extension, the government. This data could be used to build an incredibly detailed profile of every citizen, their habits, their political leanings, their social connections, their vulnerabilities. While this could be used to fight crime, it also creates a terrifying potential for social control, where our financial lives are monitored, judged, and even punished by the state. The concept of programmable money also has a dystopian dimension. A government could, in theory, program its CBDC with rules. It could prevent you from spending money on things it disapproves of, like sugary drinks or publications critical of the government. It could set expiry dates on stimulus funds to force spending, taking away your ability to save. In a more extreme scenario, access to your funds could be frozen or seized with the click of a button, effectively cutting you off from the economy without due process. This is not a far-fetched theoretical risk. We are already seeing elements of this in China's social credit system, where financial behavior can impact an individual's ability to travel or get a loan. The ECNY is designed to give the People's Bank of China perfect visibility into all transactions, a feature explicitly touted as a benefit for maintaining control. The debate over CBDCs in democratic societies is therefore a debate about fundamental values. We must ask ourselves, how much privacy are we willing to sacrifice for convenience and efficiency? Once lost, the anonymity of cash may be impossible to reclaim, forever altering the relationship between the citizen and the state. Beyond the philosophical concerns of privacy, a fully digital financial system introduces a host of practical and systemic risks. The two most pressing concerns are cyber attacks and the digital divide that excludes the most vulnerable members of society. The entire financial system would become a prime target for cyber criminals, hostile state actors, and terrorists. A successful large-scale attack on a nation's CBDC infrastructure or a major stablecoin's reserves could be devastating. It could involve stealing funds en masse, shutting down the payment network, or subtly altering the ledger to create financial chaos. Defending against such attacks would require unprecedented cybersecurity, a constant, expensive battle against ever-evolving threats. Even without malicious actors, technology can fail. A software bug, a server outage, or a widespread power grid failure could render digital money unusable. Without physical cash as a backup, the economy could grind to a halt. People would be unable to buy food, fuel, or essential services. Without safeguards, society becomes fragile and wholly dependent on flawless digital infrastructure. Finally, a cashless society risks leaving many people behind. The digital divide is real. Not everyone has a smartphone, reliable internet access, or the digital literacy to navigate complex financial apps. This includes the elderly population, people in rural or low-income areas, and individuals with certain disabilities. Forcing a rapid transition without major investment would lock these individuals out of the economy. It would create a two-tiered society, the digitally savvy versus the digitally excluded, worsening the very inequalities that digital currency proponents claim to solve. To see how these trends, opportunities, and risks play out in the real world, we can look at three distinct case studies: China, El Salvador, and Sweden. Each has taken a radically different path, providing a living laboratory for the future of money. China represents the top-down, state-controlled model. Sweden shows an organic, market-led transition to a cashless society. And El Salvador offers a bold, high-risk experiment with a decentralized cryptocurrency. China's development of the ECNY is a masterclass in centralized implementation. The project is driven by the state, with clear geopolitical objectives, and driven by domestic control objectives. In stark contrast, El Salvador made headlines in 2021 by becoming the first country to adopt Bitcoin as legal tender alongside the US dollar. The motivation was primarily to boost financial inclusion and to reduce the high cost of remittances, which make up over 20% of the country's GDP. However, adoption has been slow. Surveys show the vast majority of the population still prefers to use the dollar, citing Bitcoin's volatility and a lack of understanding. Finally, we return to Sweden, which represents a third way. Its move away from cash was not driven by government decree or a desire to adopt cryptocurrency. It was a gradual, organic shift led by banks and embraced by a tech-savvy population. Sweden's experience serves as a cautionary tale that even a smooth, market-led transition can create unintended consequences that require careful management. These three nations are on the front lines, and the world is watching to see which vision of digital money will ultimately prevail. As digital money reshapes the what of our financial lives, another powerful force is transforming the how. This force is artificial intelligence. AI is no longer a futuristic concept. It is a powerful tool being deployed across every facet of the financial industry today. It is quietly working behind the scenes, making decisions that affect millions of people every single day. From the loan you apply for, to the stocks your pension fund invests in, to the fraud alert you receive on your phone. AI is the new invisible hand guiding the flow of money. An AI-driven bank operates differently. It ingests vast quantities of data, transaction histories, market trends, social media sentiment, even satellite imagery, and uses complex algorithms to identify patterns and make predictions far beyond human capability. In trading, AI-powered systems can execute millions of orders in microseconds, reacting to market news faster than any human trader could ever hope to. In 2020, data showed that algorithmic trading accounted for around 60 to 73% of U.S. equity trading, a number that continues to climb as the technology becomes more sophisticated. The application of AI extends deep into core banking functions, like credit scoring. Today, fintech lenders are using AI to analyze thousands of alternative data points. This allows lenders to make faster, more automated decisions, often providing loan approvals or rejections in minutes rather than days or weeks, completely changing the customer experience. Risk management and fraud detection are two other areas where AI is having a massive impact. Banks and credit card companies are using machine learning algorithms to analyze your spending patterns in real time. The system learns your normal behavior, so when a transaction appears that doesn't fit, like a purchase in a different country, minutes after you used your card locally, it can be instantly flagged or blocked. According to industry reports, the use of AI has helped financial institutions prevent billions of dollars in fraudulent transactions, making the digital payment ecosystem safer for everyone involved. The integration of artificial intelligence into finance isn't just about making old processes faster. It's about creating entirely new possibilities. The primary promise of AI is a future of hyper-personalized financial services, where products and advice are tailored specifically to your individual needs and circumstances. This moves us away from the one-size-fits-all model of traditional banking, where everyone is offered the same generic savings accounts and investment options. Instead, AI can act as a dedicated financial assistant for everyone, democratizing access to services that were once reserved for the ultra-wealthy and providing a pathway to greater financial well-being for all. Imagine a banking app that does more than just show your balance. An AI-powered app could analyze your income and spending habits, automatically moving spare cash into a high-yield savings account or a diversified investment portfolio aligned with your goals. For investing, AI-driven robo-advisors are already doing this. They use algorithms to build and manage investment portfolios for a fraction of the cost of a human advisor. This opens up sophisticated wealth management to people with as little as a few $100s to invest, a significant step toward closing the wealth gap. AI can change this. By analyzing alternative data, lenders can identify creditworthy individuals who are invisible to the old models. For example, an immigrant with no credit history in their new country could be approved for a small business loan based on a consistent history of mobile phone payments and positive cash flow in their business app. This creates economic opportunity where none existed before, fueling entrepreneurship and helping families build a secure financial foundation. Furthermore, AI can significantly enhance financial literacy. AI-powered chatbots and educational tools can provide clear, simple, and personalized guidance around the clock. You could ask your banking app, "What's the best way for me to save for a down payment on a house?" and receive an instant, customized plan based on your specific financial situation. This constant, accessible support can empower individuals to make smarter financial decisions throughout their lives. It transforms the bank from a passive holder of money into an active partner in achieving financial goals, fostering a more informed and capable population. While the potential benefits of AI in finance are enormous, the technology also comes with a set of profound and deeply troubling risks. The very data that fuels AI's power can also be its greatest weakness, leading to discriminatory outcomes hidden within complex algorithms. The first major danger is algorithmic bias. An AI system is only as good as the data it is trained on. If historical data reflects societal biases, and it almost always does, the AI will learn and amplify those biases. For example, if a loan application dataset historically shows fewer approvals for certain neighborhoods or demographics, the AI will learn to discriminate against future applicants from those groups. This creates a high-tech version of redlining, where discrimination is not the result of a conscious human decision, but is baked into the code itself. The problem is made worse by the black box nature of many advanced AI models. A black box algorithm is one where even its creators cannot fully explain why it made a specific decision. The AI might deny someone a loan, but it can't provide a clear, understandable reason. This lack of transparency makes it incredibly difficult to challenge or audit the AI's decisions, undermining principles of fairness and due process. You could be denied a financial opportunity for reasons you can never know or rectify. The immense data collection required for AI also raises serious privacy concerns, echoing the risks we saw with digital currencies. Your financial institution could build an intimately detailed profile of your life, not just your transactions. It could infer your health status. It could infer your political beliefs. It could infer your personal relationships. This information could be used to price products differently. It creates the potential for a new form of social scoring, not by the government, but by private corporations who hold the keys to your economic life, a big brother in the private sector. Finally, the increasing reliance on complex, interconnected AI systems introduces new forms of systemic risk. If a handful of major AI providers service the entire financial industry, a single bug in one of their core models could have cascading effects across the global economy. A flawed trading algorithm could trigger a flash crash. A compromised risk management AI could fail to spot the next major financial crisis brewing. The speed and automation of AI mean that such crises could unfold in minutes, far too fast for human intervention. We risk building a system that is not only biased and opaque, but also dangerously fragile. While AI seeks to perfect the existing financial system, another, more radical movement aims to replace it entirely. This is decentralized finance, or DeFi. DeFi is an ambitious attempt to build a completely new, open, and transparent financial system from the ground up, using blockchain technology, primarily the Ethereum network. It takes the decentralized idea behind Bitcoin and applies it to a much wider range of financial services like lending, borrowing, trading, and insurance. The core principle of DeFi is to remove the traditional intermediaries, banks, brokers, insurers, that currently sit at the center of our financial world. In the traditional system, which we can call centralized finance or CEFI, you rely on a trusted institution to manage your money. Your bank holds your deposits. A brokerage executes your trades. An insurance company underwrites your policy. DeFi offers a fundamentally different architecture. Instead of relying on institutions and their employees, DeFi relies on code. Specifically, it uses smart contracts, which are self-executing programs that run on a blockchain. These smart contracts act as the rulebook for a financial transaction. For example, a smart contract for a loan could automatically hold a borrower's collateral and release it back to them only when the loan is fully repaid. Because the code runs on a decentralized blockchain, it is transparent for anyone to inspect and cannot be altered or stopped by any single entity once it is deployed. This creates a financial system that is, in theory, open and permissionless. Anyone with an internet connection and a crypto wallet can access DeFi services without needing to fill out an application, pass a credit check, or even provide their name. The rules are the same for everyone, whether you are a hedge fund manager with $1 billion or a student in a developing country with $50. This radical accessibility is the driving force behind the DeFi movement. It envisions a global, interconnected financial marketplace that is more equitable, more transparent, and more efficient than anything that has come before it. So what can you actually do in this parallel financial universe? The DeFi ecosystem has exploded with a wide array of applications. These applications are often called dApps and can be accessed from your crypto wallet. The most prominent use cases revolve around lending and borrowing, decentralized trading, and earning yield on your digital assets. One cornerstone is decentralized lending platforms. They let users lend crypto to earn interest or borrow crypto by using other assets as collateral. It's like a digital pawn shop. Another key component is the decentralized exchange, or DEX. A DEX lets you trade crypto directly from your wallet. This contrasts with centralized exchanges like Coinbase and Binance, which custody your funds. With a DEX, you keep self-custody. Trades run peer-to-peer through an automated market maker, AMM. And this model provides greater security against exchange hacks and prevents the platform from freezing or seizing your assets, giving users complete control. Beyond lending and trading, DeFi offers yield farming and liquidity mining. Users can provide assets to a protocol, for example, liquidity for a DEX trading pair. Protocols reward providers with trading fees or with native governance tokens. This creates a competitive space where savvy users can earn high yields, but often face high risks. Putting assets to work in the financial plumbing is a unique DeFi feature. The innovative and open nature of DeFi also makes it a dangerous and volatile environment, often compared to the Wild West. The promise of high returns and permissionless access comes with a myriad of risks unfamiliar to those used to traditional finance safety nets. No consumer protection agencies, no deposit insurance, no central authority to appeal to if something goes wrong. The biggest technical risk comes from the very code that powers the system, the smart contracts. A tiny bug or vulnerability in a smart contract's code can be exploited by hackers, leading to instantaneous and irreversible loss of all funds. These are not theoretical concerns. The history of DeFi is littered with high-profile hacks and exploits totaling billions of dollars. According to blockchain security firms, over $3.8 billion was stolen from crypto platforms in 2022 alone, with a significant portion from DeFi protocols. Beyond malicious hacks, there is risk of economic exploits and protocol failure. A flash loan, borrow millions with no collateral for a single transaction, can be used to manipulate prices on a decentralized exchange and drain funds from a lending protocol. Compounding all these risks is massive regulatory uncertainty. DeFi operates in a legal gray area in most jurisdictions. Governments and regulators are struggling to apply existing laws. Who is responsible when a protocol fails? The anonymous developers? The users who voted on governance? This lack of clarity makes accountability difficult, provides little recourse for users, and the global and pseudonymous nature of DeFi makes effective oversight extremely complex, leaving users to navigate this high-stakes environment largely on their own. Section 7. Centralized versus decentralized, a clash of financial philosophies. The simultaneous rise of AI-driven finance and decentralized finance sets the stage for a fundamental conflict over the future architecture of our financial system. These two trends represent a clash of competing philosophies. On one hand, AI-driven finance, or CFI 2.0, represents an evolution of the current system. It seeks to make the centralized model more efficient, more intelligent, and more personalized. On the other hand, decentralized finance represents a revolution. It rejects the hierarchical model entirely, advocating for a flat, an open, and transparent network where power is distributed among users. DeFi's philosophy, "Don't be evil," is not enough. It should be, "Can't be evil." It aims to build a system where trust is not placed in institutions, which can be corrupted or fail, but in transparent, verifiable code. The future of finance by 2050 is unlikely to be a complete victory for either side. Instead, we are likely to see a complex and often messy integration of both models. We may see traditional banks using AI to interact with DeFi protocols on behalf of their customers, acting as a regulated and user-friendly gateway to the decentralized world. This would offer users the innovative products of DeFi combined with the consumer protection and familiar interface of their existing bank. This hybrid model, sometimes called CDFI, attempts to capture the best of both worlds. Ultimately, this clash is about our core values. Do we prioritize efficiency and security, which may lead us to a more centralized, AI-driven system with potential for surveillance? Or do we prioritize individual sovereignty and openness, which leads us to a more decentralized system with higher personal responsibility and inherent risks? The path we take will have profound implications for wealth distribution, privacy, and the very nature of economic power. The tension between these two powerful forces, the drive to perfect the center and the drive to dissolve it, will be the defining financial drama of the coming decades. Section 1. The Great Unbundling and Rebundling of Banks. The immense pressure from AI-driven fintechs and decentralized protocols is forcing traditional banks to undergo a painful but necessary identity crisis. For the past century, the universal bank has been the dominant model, a single institution offering checking accounts, mortgages, credit cards, and investment advice. This bundled approach created a one-stop shop for a customer's financial needs. However, technology is systematically breaking this model apart in a process known as the Great Unbundling. Specialized fintech startups are targeting individual banking services, doing them better, faster, and cheaper than the incumbent giants, chipping away at the bank's dominance piece by piece. This has left many large banks looking like slow, expensive, and outdated conglomerates, struggling to keep pace with a legion of specialized and technologically advanced competitors. After this period of fragmentation, a new trend is emerging, the Great Rebundling. But this time, the model is different. Instead of trying to build every single product in-house, the bank of the future will act as a platform or a marketplace. It will use its trusted brand and customer relationship as the core, but it will curate and offer a range of best-in-class financial products from various third-party providers, all integrated into a single seamless digital experience. Your bank account would become the central hub through which you access a mortgage from one provider, an investment product from another, and an insurance policy from a third, all managed within your primary banking app. Section 2. The Future of Global Payments. Beyond SWIFT. For the past 50 years, the way money moves between countries has been dominated by a single system, SWIFT. It is the backbone of international finance, connecting more than 11,000 financial institutions across over 200 countries. But SWIFT is a product of its time. It can be slow. Transfers can take several days to settle. It is also expensive. SWIFT's dominance is being challenged from multiple directions. One major challenge, stablecoins. Another, other digital assets built on blockchains. These let value move peer-to-peer across the globe, in minutes, not days, and at a fraction of the cost. Example, a US company paying a supplier in Japan. Using a US dollar-pegged stablecoin, the transaction can settle almost instantly, bypassing the correspondent banking system entirely. Central banks are entering the fray, exploring CBDCs to revolutionize international payments. Project mBridge, China, Hong Kong, Thailand, and UAE, is building a real-time cross-border payments platform using CBDCs. The future likely won't be winner takes all. We're heading toward a fragmented, multipolar world, a SWIFT system for regulated institutions, blockchain-based rails for digital assets, dedicated CBDC platforms for transactions between allied nations. The battle to control these new financial highways will define the global economy through 2050. Section 3. The Rise of the Platform Bank, a financial super app. As banks grapple with the unbundling of their services and the need to rebundle them in a new way, a clear model for the future is emerging, the platform bank. This is a bank that functions less like a traditional financial institution and more like a technology company, such as Apple with its App Store. The goal is to become the indispensable super app for a customer's entire financial life, a single gateway to a universe of financial services. Imagine opening your primary banking app. From this single interface, you would not only see your checking account, savings account, but you could also view your investment portfolio managed by a third-party robo-advisor, check on your mortgage application with a specialized online lender, and even purchase insurance from a completely different company. This model offers significant benefits for both the customer and the bank. For the customer, it combines the convenience of having everything in one place with the competitive pricing and innovation of the open market. For the bank, it allows them to expand their offerings without having to invest in building everything themselves. They can generate revenue by taking a small fee for transactions that occur on their platform, much like Apple takes a commission on App Store sales, creating a highly scalable and profitable business model. We are already seeing the early stages of this transition globally. In Asia, super apps like WeChat and Alipay have already integrated a vast array of financial and lifestyle services into their platforms. In the West, established banks are increasingly partnering with fintechs or using open banking regulations to allow customers to connect accounts from other institutions. By 2050, this trend is likely to culminate in a financial landscape dominated by a handful of these platform banks. The competition will no longer be about who has the most physical branches, but who has the most user-friendly digital platform and the most comprehensive ecosystem of integrated services. Section 4. Democratizing Wealth. The new era of investing. Just as banking is being transformed, the world of investing is undergoing its own radical democratization. For generations, building wealth through investing was a complex and often exclusive activity. Today, a new wave of investing platforms, powered by technology, is systematically dismantling these barriers. One of the most powerful innovations is the rise of fractional ownership. In the past, if you wanted to invest in a company like Amazon, you had to buy at least one full share, which could cost thousands of dollars. New trading platforms allow you to buy a fraction of a share for as little as $1. This simple change is a game changer. It means you can build a diversified portfolio of many different stocks, even with a small amount of money. This has opened the door to stock market participation for a whole new generation of younger, less affluent investors who were previously priced out of the market. Alongside fractional shares, the growth of robo-advisors has automated the process of investment management. Instead of paying high fees to a human financial advisor, a user can simply answer a few questions about their financial goals and risk tolerance. An algorithm then automatically creates and manages a diversified, low-cost portfolio for them. Finally, the rise of social trading platforms has added a new community dimension to investing. These platforms allow users to see what other investors are buying and selling, share their strategies, and even automatically copy the trades of successful individuals. This blends the mechanics of a social media network with an investment brokerage, creating a powerful and sometimes dangerous feedback loop. While it can help educate new investors and provide a sense of community, it can also lead to herd behavior and the rapid inflation of speculative bubbles, as seen with the meme stock phenomenon. Section 5. From stocks to sneakers, the tokenization of everything. The democratization of investing is about to take another giant leap forward with a concept known as tokenization. This is the process of creating a digital representation, or token, of a real-world asset on a blockchain. These tokens can represent ownership of almost anything, from tangible assets like real estate, fine art, and classic cars, to intangible assets like intellectual property and future revenue streams. Once tokenized, ownership can be split into thousands or even millions of tiny fractional pieces and traded on digital marketplaces 24/7 anywhere in the world. This could unlock trillions trapped in illiquid assets. Imagine a commercial building worth $100 million. Traditionally, only institutions or ultra-high net worth individuals invested in that. Tokenization could divide ownership into 1 million tokens, each $100. An ordinary investor could buy a small piece of prime real estate, earn a share of rental income, and benefit from appreciation. The vision is early, but the tech is being built today. The biggest hurdles are regulatory, not technological. Governments must set legal frameworks for classification, issuance, and trading to protect investors and safeguard financial stability. The direction is clear. By 2050, the line between traditional and digital assets may fade as tokenization moves nearly every store of value onto a global blockchain ledger. Section 6. New rules for a new game. The profound changes sweeping through global banking and investing platforms are creating enormous challenges for regulators and policymakers. The rules and institutions that have governed finance for the past century were designed for a world of physical branches, national currencies, and clearly defined asset classes. They are ill-equipped to handle a world of borderless digital currencies, decentralized protocols, and tokenized assets. One of the biggest regulatory dilemmas is how to apply existing securities laws to the new world of digital assets. Is a cryptocurrency a commodity? Is it a currency? Is it a security? The rise of global stablecoins and super apps presents a major challenge to monetary sovereignty and financial stability. If a large share of people use a corporate stablecoin for daily transactions, a nation's central bank could lose its ability to implement effective monetary policy. These technological shifts are deeply intertwined with geopolitics. CBDCs and alternative payment systems challenge the US dollar's role as the world's reserve currency. This could splinter the global financial system into competing blocks. One around the dollar and SWIFT, another around the digital yuan and its infrastructure. Control over standards and platforms will be a major source of geopolitical power. The regulations and technological choices made today will draw the economic and political battle lines for 2050. Section 1. The Unwritten Ledger. Throughout this journey, we have explored the powerful forces reshaping our financial world. The future of money is not a single, monolithic trend, but a complex interplay of technological innovation and human choice. Our analysis reveals a delicate balance. For every incredible opportunity, a corresponding risk. A more efficient financial system, a more inclusive financial system, a more accessible financial system, weighed against mass surveillance, algorithmic bias, systemic fragility, and loss of individual autonomy. The path to 2050 is not predetermined. The outcome depends on choices we make today, as individuals, as businesses, and as societies. We are writing the next chapter in the history of money. The ledger is still open. We must choose wisely what we write in it. Section 2. 3 Roads to 2050. As we look towards the horizon of 2050, the confluence of these trends could lead us down several distinct paths. We can imagine 3 plausible scenarios for our financial future, ranging from optimistic to risky. The first scenario is an optimistic one, a future we might call the inclusive digital commonwealth. In this world, technology has been successfully harnessed for the collective good, guided by thoughtful and collaborative regulation that balances innovation with safety and individual rights. In the inclusive digital commonwealth, central bank digital currencies have been designed with strong privacy protections, acting as a public utility that ensures everyone has access to basic, low-cost digital payments. AI-driven finance is governed by strict transparency and fairness standards, reducing bias and empowering consumers with personalized, trustworthy advice. Decentralized finance has been integrated into the mainstream system through regulated gateways, offering innovative products while protecting consumers. A second, perhaps more realistic possibility is the fragmented fortune scenario. In this future, the benefits of financial technology have been captured unevenly, and regulation has been patchy and inconsistent. Some countries have adopted privacy-preserving digital currencies. Others have used them for surveillance. This has created a digital iron curtain in the global financial system. Finally, we must consider the riskiest scenario, the concentrated control future. In this world, the darker implications of technology have come to pass. A few dominant tech companies and powerful nations control the core infrastructure of global finance through proprietary platforms and surveillance-first central bank digital currencies. Privacy is a forgotten luxury, as every transaction is monitored and analyzed by both corporations and governments. Section 3. Navigating the New World. The future of money is not something that simply happens to us. It is something we build together. For policymakers and regulators, the primary challenge is to create agile and forward-looking rules. Digital identity frameworks, robust data protection laws, privacy as a core feature of CBDCs, collaboration across borders to set global standards, avoiding a regulatory race to the bottom. For businesses and financial institutions, adapt or fall behind. Embrace the platform model. Shift from product manufacturers to trusted curators of financial services. Invest in technology. Invest in user experience. Form partnerships with fintech innovators. For individuals, education is the most powerful tool. Improve your financial and digital literacy. It's essential for economic survival. Understand the basics of digital currencies, learn the risks of online scams, and master principles of sound investing. Demand transparency and privacy from your financial providers. 2050 will be profoundly different, and our relationship with money will be at the heart of that transformation. Technologies are not good or evil. They are powerful tools. The future depends on how we choose to wield them. Foster collaboration, prioritize human values, and embrace lifelong learning. Build a financial system that is more technologically advanced, more equitable, more transparent, and more empowering for everyone. The future of your money is unwritten. We all have a hand in its creation.
Inflation is a quiet force. It is the gradual rise in prices for goods and services over time. It is a concept that sounds academic, something discussed by economists on news channels. But it is not just an abstract idea. It is a real and tangible presence in our daily lives. Inflation means that the dollar in your pocket today will buy less tomorrow. It is a slow, almost invisible erosion of your purchasing power. You might not notice it from one day to the next, or even 1 month to the next. But over years, and certainly over decades, the effect is profound and undeniable. It changes the value of your savings, your income, and your future. Price tags from then versus now tell a powerful story. Purchasing power is the real measure of your wealth. It is not about how many dollars you have, it is about what those dollars can actually buy. Inflation is the direct enemy of purchasing power. When prices go up, each dollar you own becomes weaker, capable of acquiring a smaller slice of the world's goods and services. Imagine a favorite pizza that costs $20. If your income stays the same and inflation raises that pizza to $22 next year, your money has effectively become weaker. You can no longer afford the same simple pleasure without spending more. This is how inflation makes us feel poorer, even if the account balance looks the same. With a steady 3% inflation rate, the math is straightforward but startling. Next year, about $3.09. 5 years, about $3.48. 10 years, about $4.03. 20 years, about $5.42. The price nearly doubles while the coffee does not change. This slow creep is deceptive. We adjust and absorb small increases. In a world with inflation, cash is not a safe haven. It is a guaranteed loser. This is one of the most counterintuitive ideas in personal finance. We are taught to think of cash as the ultimate form of security. It is tangible. It is simple. There is no risk of it crashing like the stock market. But this perception of safety is an illusion. While the nominal value of cash is fixed, a $20 bill is always a $20 bill. Its real value is constantly in decline. Every day, cash in a checking account or under a mattress buys a little bit less than yesterday. It is a melting ice cube, slowly but surely losing its mass. Holding cash during inflation is like standing on a downward moving escalator. To make progress, or even to stay in place, you must walk upwards. Simply standing still means you are going down. If inflation runs at 4% and savings earn 1%, you are still losing about 3% of purchasing power. Historically, cash returns have trailed inflation over meaningful periods. We fear flashy volatility, but ignore the quiet, certain loss from inflation. This does not mean zero cash. Keep liquidity for bills and emergencies. The first and most fundamental move to combat inflation is to become a disciplined and strategic saver. Create a plan to set money aside and place it where it can try to keep pace with rising prices, a high-yield savings account. It rarely beats inflation, but it reduces the damage. Research banks, especially online, and find the highest APY. Open online, then automate transfers every payday. Even 50 or 100 a month adds up thanks to compounding. Build your 3 to 6 month emergency fund here. Consider certificates of deposit for money you will not need for a set term, often higher rates without market risk. Use savings and CDs as defense, not a get-rich plan. This creates a stable base for long-term investing. Without intentional saving, investing rests on shaky ground. Saving is about defense, but investing is about offense. To truly beat inflation, your money must grow faster than prices. That is the purpose of investing. Invest in assets that can outpace inflation. For most, stocks are the most accessible. A stock is a small slice of a company. As companies grow and profit, your stake can grow. Historically, stocks have beaten long-term inflation. You do not need to pick individual stocks. Use low-cost index funds or ETFs. They track major market indexes. Buy one S&P 500 fund, own pieces of 500 companies. Instant diversification. Focus on time in the market, not timing the market. Use dollar cost averaging. Invest the same amount monthly. You buy more when prices are low and fewer when high. Small consistent contributions compound into real wealth. Open a Roth IRA or brokerage in minutes and start with small amounts. The most important step is to start. Earlier money has more time to compound. Practice intentional spending every day. Align money with your values. Insert a waiting period for non-essentials. Choose durability and value over cheap and disposable. Think of your parents or grandparents. Their prices sound like fiction, but they are data points. A new car for a few $1,000s. A house for what a down payment costs today. A candy bar for a nickel. The milk has not changed. The container has not changed. The money's value has. Bury $100 for 20 years. It is still 100 on paper. But what it buys is dramatically different. Inflation steals value. Not the bills, but what they represent. Understanding this is the first step to protection. Plan for future goals and future dollars, or you will face a shortfall and a moving target. Ignoring inflation is like filling a leaky bucket. You must pour faster just to stay even. Inflation is powerful, but not a financial death sentence. Meet it with strategy, discipline, and knowledge. You cannot control inflation, but you can control your response. 3 core moves: saving smartly, investing for growth, spending with intention. Shift perspective. Cash melts. The market is a long-term growth vehicle. Act now. Auto-transfer $50, start a Roth IRA index fund, and wait 24 hours before non-essentials. Small steps, compounded over time, create freedom. Take the first step today. Like, share with someone who might benefit. Subscribe for more. Subtitles are available for accessibility.